I think for Lido in particular, it just means that Lido, even though it's an upgradable smart contract system, it almost has the security of an immutable system, in the sense that good proposals can pass, but bad proposals are extremely unlikely to pass. So it basically requires all the staked ETH holders to be kind of asleep at the wheel. So this is almost like a filter that really raises the bar for how secure upgradable smart contract systems can be, and I think it just flat out makes Lido the most secure staking protocol.
Hi everyone, welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. Every episode, we want to feature what you have to say. Today we have listener comments responding to my recent interview with Lee Bratcher on the state of Texas's recently announced strategic Bitcoin reserve. On X, Storm Trade said, "When states enter the Bitcoin game, it's not about if, but when the big money follows." And Rukawa Kaede wrote, "Head off, inevitable." To hear a comment on a future show, write a review of the podcast overall, or leave a comment on our video on YouTube, X, or Farcaster. This is the July 1st, 2025 episode of Unchained. Crypto moves fast. It's why Bitwise launched the weekly CIO Memo, a jargon-free summary of what's moving crypto markets, written by one of the best in the business, CIO Matt Hogan. Get up to speed in 5 minutes or less. Check it out at bitwiseinvestments.com/CIO Memo. Carefully consider the extreme risks associated with crypto before investing. Hi everyone, today we have a live stream. The guests are Hasu, strategic advisor to Lido and strategy lead at Flashbots, and Vasiliy Shapovalov, co-founder of Lido. Welcome to Hasu and Vasiliy.
Thanks, Laura. Good to be here. Very excited.
Yeah.
Hey.
Excited to chat. We have just seen that Lido has passed a dual governance proposal that will give the holders of Lido's staked ETH token a way to delay or veto Lido governance proposals. But before we dive into all the details around what just passed, why don't we first look at what it is that you guys were trying to solve in terms of like what problem you were trying to solve, what issues you had with the old Lido governance model.
So I think one of the things that makes crypto unique is that as a user, you should always be in control. You should always be able to exit a protocol when you want to, and you shouldn't really have other people make decisions on you. And so when you reflect on something like a Uniswap deployment, then clearly that's the case, right? So there's like a Uniswap pool once deployed, it's immutable, and the only way to deploy a new one is actually to deploy a whole new version of Uniswap, which happens once every 1 to 2 years. But there are some DeFi protocols where that is inherently hard to do because they need some amount of upgradability and can't just have users switching over like that. So that includes lending markets. So for example, you see protocols like Aave or Sky that need to update their interest rates and stuff like that and collateral limits. But it also includes generally all decentralized staking pools because as a staking pool, Ethereum itself is always changing. Like with every new fork, stuff changes that we need to adapt to even stay compatible with Ethereum. And so we need to be able to update the protocol as the developers. But as a user, this means that you are always exposed to a certain risk from the protocol changing, not only in ways that you like and that are good for you, but also changing potentially in ways that you don't like. And kind of the worst case example of this is a governance attack where somebody, buys or steals a lot of LDO and then, implements a proposal that is very harmful for users and gets that passed through the on-chain governance. And so usually the way that protocols handle this is through so-called time locks. So a time lock is the idea that if you, in order for a proposal to pass, some amount of time, so first the proposal passes, and then you have a window of time where users can look at, what is going to change. And if they don't like it, they can exit. Okay, so that one's kind of a very obvious solution. But the problem with Lido in particular, because of Lido's size and also the size of the Ethereum withdrawal queue, the way that withdrawing works from the beacon chain, you can't make a time lock that's actually long enough. Or if you were to make it long enough so that all users could safely withdraw, then this would take months. And so the challenge that we try to solve is, how do you make a time lock that's actually dynamic? How do you make a time lock that is really short if the proposal is clearly friendly and good for the protocol, but it can be as long as necessary for everybody to withdraw in a very safe and relaxed manner if the proposal is deemed to be unfriendly? And so that's the starting point for us.
And Vasiliy, do you want to add anything?
The gist is correct. That's the main reason, main problem that is solved by dual governance. It's a way to solve principal agent problem for a protocol that has to be upgradable. The one thing that I would add is that dual governance, as it implemented, has a multiple options for signaling and de-escalation built in. So I think it's going to be useful in cases where it's not quite a governance attack. It's not quite a risk for the stakers. It's something that is not in the interest, but is not really an attack or a theft or a hack. Like something like changing the not operator composition to one that is not to the likings of the stakers, or changing the fees in some way, adding features to the protocol that are not desired by some stakers, etc., etc. And dual governance allows people to signal their displeasure by raising the temporary veto on the change. For the token holder governance of Lido to de-escalate by rolling back the change if they see that it's not to the likes of the users. So I'd say that is a really powerful consumer client protection mechanism for a protocol.
Yeah, and one other point, which is probably obvious to a lot of people who are very familiar with crypto, is just simply that the number of LDO token holders, the number of people who hold the Lido governance token, is probably nowhere near as big as the number of people who hold staked ETH. And so, it's just the main people who are using the protocol are not always the one who have a stake in a say in the governance. Okay, so now let's dive into how the dual governance model works.
The way that it works is, so I described this to be a dynamic time lock, right? So basically, the time lock starts out assuming that everything is fine, but then if certain things happen, it basically we get a signal that something is not fine. Then the time lock will extend, giving people time to withdraw. So the way that it starts is we want to give these staked ETH holders the ability to express that something is not how they like it. And so we should slow things down, right? And so there are two thresholds here required. So at 1% of staked ETH depositing into the dual governance contract, it's basically saying we're entering an escalation period. And this is what Vasiliy touched on. And from there, it can either kind of escalate or de-escalate. And if more people keep piling on, if more people keep staking their staked ETH into the dual governance contract, then at 10%, you reach the period where the protocol is basically frozen and everybody can withdraw. So those are the two thresholds. So 1% to buy enough time for everybody to look at what's going on. And then 10% is the trigger where enough people say, something is not looking right. And then it's basically you enter this state of freezing where no governance proposal can pass and everybody can safely withdraw no matter how long it takes.
And the pauses have certain lengths of time, right? So once the 1% threshold is reached, then what happens, and then how long is the freezing?
It's a dynamic interval, but in general, the minimum duration of dynamic time lock is 5 days. It's for the 1% signal, and the maximum delay for dynamic time lock's maximum duration is 45 days. So it's quite a lot of time to gather all the needed power on the to rage quit basically from the protocol.
And how were those percentages and timeframes chosen? Was it based on anything, using like historic execute lengths, or any simulations about like worst case scenarios, or how did you come up with those?
It's models and simulations. It's a mechanism to protect us against tail risks. We didn't have this tail risk realized. We wouldn't be talking if this tail risk realized. Like in general, if there was a successful governance to Lido, it would be a bit too late to implement dual governance. So by necessity, there is no good practical examples of things to rely upon. And there are some historical governance attacks I think there was very small lending protocol on Binance, BNB chain that was attacked, but like these cases nowhere near of the scale and impact of Lido. So we had to model things, and the most important parameters of the model basically how many people very near the keys to signal the first threshold. What is a reasonable amount of time and amount of stake to signal that there is something fishy and we need to look in deeper. And in a way that is not available to just like anyone to pause the protocol, pause the upgrades to the protocol essentially free. So should be high enough to not be easily available to a bad actor, but low enough for good actors to be able to react on it like really fast. And the second threshold is what the amount of stake ETH that we can reasonably expect to be active in a short time frame, but like a few weeks or slightly more than a month's time frame. So that's how we chose this.
And one other thing I wanted to ask, so we have this period in the rage quit stage where new proposals cannot be executed, and during that time, I guess what kind of determines what happens is either the dissenting stakers they all fully withdraw, or the DAO drops the measure, meaning the dissenting stakers like fully withdraw from their staked ETH. So is it just a period where it seems like at that point the dissenting stakers would most likely withdraw? I'm guessing that's how I was thinking about it, but maybe not. Like, what would force the DAO to say, hey, we're going to drop the measure? Because it seems like that would be the only thing that would keep them from deciding they're all going to leave. So, is it just like a bunch of discussions and then like there's some kind of decentralized vote amongst the, either the LDO token holders or I don't know. So how would that be decided?
On the social layer, it's not set in by the proposal. It only has a technical and smart contract rails to implement it. So on technicals, it just assumes in 45 days, either the LDO holders agree to vote for rolling back the change, and the whole issue disappears. Everything is rolled back to the previous state. Or LDO holders will not roll back the change, and then it means that the stakers who signal the rage quit, desire to rage quit, they are automatically put to the unstake. So
I'm sorry, they're automatically, what did you say?
Unstaken. Automatically unstaken. Like they are quitting the protocol, and the changes don't apply to them. Basically, they just get the ether that was staked with Lido, but they are protected against like anything that changes in the protocol or in the DAO. On practical terms, this is in technical terms, LDO holders can vote to roll back the proposal. So the path of the proposal in this case would be LDO holders propose one, vote for one to go over the quorum threshold, like positive quorum threshold, then wait until the dual governance kicks in and stop the proposal, like puts it on pause until the first and second threshold are met. And then they can LDO holders can either vote to roll the proposal back and be back to square one, or they can refuse to do that, and then the dissenting stakers get their stake back and quit the protocol.
One thing that I could imagine would be that basically the deciding factor would probably be the percentage of people who have entered the dual governance contract and are indicating that they will rage quit. Like if it's just like barely above the threshold, then maybe the LDO token holders would be less inclined to reverse the proposal. But if it's a significantly higher number, maybe they might be more willing to consider that. So I did also want to ask, like, just generally, when you think about the ramifications that you think this change will have, why is it that you think it's significant? And how do you expect it will impact either how Lido is used or who uses it?
Yeah, so I think that dual governance is very exciting and kind of fundamental for mainly two reasons. So I think for Lido in particular, it just means that Lido, even though it's an upgradable smart contract system, it almost has the security of an immutable system, in the sense that good proposals can pass, but bad proposals are extremely unlikely to pass. So it basically requires all the stake holders to be kind of asleep at the wheel. So this is almost like a filter that really raises the bar for how secure upgradable smart contract systems can be, and I think it just flat out makes Lido the most secure staking protocol. And this, for a long time, I think this was one of the advantages that more direct forms of staking would have, ones that don't give you liquidity. So you always had to choose, do you want maximum security and non-custodiality by directly staking? Or do you want liquidity, which requires you to opt into some smart contract system that will then by definition be upgradable, because that's necessary if you build it on Ethereum today. And dual governance basically removes this dilemma, right? It just removes it. So you had to choose between maximum security or liquidity, and now you can have both. And so I think from a protocol perspective for our users, it's a really big upgrade. And second, I think that this, dual governance is not just a feature. I think it's a principle. It's the idea that you can have systems that are governed by multiple stakeholders in a cryptographically verifiable way at the same time. And so I think this is, one of the very cool things about crypto is that, we are making some stuff better at the margin, but we're also inventing entirely new stuff that doesn't exist outside of crypto, that we're really pioneering here, right? And so I think, there's no companies out there in Web 2 where, as a user, you have a cryptographic guarantee that they can't just raise the fees on you, for example, or that they can't start selling your data, or that they can't in any way change the terms on you in a way that you don't agree to. And I think that's what makes dual governance really special. So I think today dual governance is something that we associate with Lido. But my hope is that dual governance is just a term that we use kind of colloquially in crypto and eventually beyond to describe many things that give users power over the services that they use.
Yeah, honestly, it reminds me of maybe you could call it like a referendum style of governance, where, for instance, there have been periods when I've lived in California, and of course you have your elected state representatives, but then the state often has these referendums that are on the ballot, and then everyday people can vote on different measures. And obviously this isn't exactly that, but it's if it were designed more where the California state legislature would have votes, and then everyday citizens could have a function by which they could veto those or at least delay them. So one other thing I wanted to just say is I do think that this could make Lido more appealing to institutions who want to participate in DeFi. That would be another aspect that I think could change. Vasiliy, do you want to add anything?
I agree on that. I think that in terms of security guarantees for the decentralized protocols, Lido is a bit ahead of the market in this, like in both on the supply and demand side, as in people don't require that from the protocols as they are right now. So there are protocols that, for example, are immutable and cannot be upgraded in any way. And there are protocols that fully basically multi-sig upgradable. And there's a difference in how much value they can attract that can be used, but this difference is not super high. Like people don't put a lot of that much attention to it. I think this will change as we go in the era of more major protocols, of more major decentralized finance, and more major users, like institutional users and extremely security conscious users. So eventually, I think nation states and stuff like that, they will put a lot of effort into risk management, and this includes risk management on the governance risk as well. The other trend that is, I think, will put higher emphasis on security and governance risk mitigation measures is just that cyber attacks are trending higher every year. Like more and more and more harm is done by them. So this trend is not stopping, and I think with AI attackers, it will just like continue to go higher. So we'll have just more attacks and more harm done by them, and that will make people consider the safeguards and the risk mitigations more. So I think we are a bit ahead on the trend on this. I think that it's the right thing to do in holistic sense, like it's the right thing to do to give the stakers means to not be at whims of the governance of the protocol. They don't have to trust fully. They only have to trust that the code is written right, basically. And I think that it just makes us a bit more better positions for the future.
All right. So I'd be interested also to hear like how you came up with this design. Like, I know this has been a few years in the making. So how did this particular design come about?
Oh, it's out of these two and like a bit more than 2 years of work. I think the design took the most time. Like we put a lot of effort into implementation, but we had multiple back and forth about like what is feasible, what is possible, what is likely in terms of threats and attacks, what is acceptable risk, not acceptable risk, what would be the right approach to this. We started with a lot of things that could be done. So right now, dual governance is essentially a form of very sturdy rage quit. So that if you don't want to be in protocol when it changes, you can always quit. This is a really good approach to have. Other approaches included full opportunity for dual governance, like giving the opportunity for stETH holders to vote on all the stuff and roll back some stuff and propose more changes. Things like full shutdown the protocol inside things like instead of rage quit of dissidents. So a lot of options, and ultimately we end up with more tame design, because otherwise it would be very risky to have dual governance systems. Very there is a lot of them in the real world. Like every major governance system is dual governance more. Like there are 3 branches of powers, and in the US, for example, right? And the legislative branch is 2 chambers, so it's more like 5-fold governance or something. And it works because when there is a deadlock, there is a way to resolve this, and the way to resolve this deadlock is usually some form of emergency power over the governance system, or some form of violence. So like some forms of deadlocks between governance are only expected to be resolved by essentially a coup or like a rebellion or something like that. You can't have this on the smart contract level, and like you can't really rely on expect people to be up in arms about the staking protocol. So you can't replicate that. You need to design something that can't have any deadlocks at all, because deadlocks in smart contracts is just mean the protocol stop working and like everyone isn't happy. So, and the other vector of harm to Lido and to users that is possible is an outside actor staking some amount of Ether into protocol, like a lot of Ether, for example, and then using it to harm the protocol if the protocol allows it. So if the protocol would allow to dismantle, if DAO governance would allow to dismantle the protocol wholesale, it would be very vulnerable to outside actors. So I think we had about like 25 cycles of back and forth, different options, evaluations, models, and stuff like that, and ended up with a very well thought out system that can't be deadlocked and is protecting the stakers and is allowing emergency upgrades if we need emergency, like if there is a need for an emergency upgrade. I'd say this is most complex change to the protocol we have made overall.
All right, so in a moment, we're going to talk a little bit more about how the design came about. But first, we'll take this quick word from our sponsor.
Hi, I'm Matt Hogan, CIO of crypto asset manager Bitwise. Look, crypto can be confusing. There's so much noise and the space changes so quickly. That's why, every week, I write a 5-minute memo on the biggest stories impacting crypto, in plain English. Why is Bitcoin up or down? What are people missing? Where should investors look next? Get the lowdown every week. Sign up to get the weekly CIO memo delivered straight to your inbox. Go to bitwiseinvestments.com/CIO memo. That's bitwiseinvestments.com/CIO memo.
Carefully consider the extreme risks associated with crypto before investing.
Here are more listener comments responding to my interview with Lee Bratcher and the bipartisan support for Bitcoin in the state of Texas. On X, Khaki Stocracy said, states shouldn't buy BTC on the open market. States should hold Bitcoin seized or mines. US states actually have the capacity to mine Bitcoin. What do you think? To hear your take featured on a future episode of Unchained, please write a review or leave a comment on YouTube, Farcaster, or X. All right, so I'm back with Hasu and Vasiliy. Hasu, did you want to add anything on how you came up with the design?
Yeah, I mean, I can maybe try to frame it in like the bigger picture, because Lido has a decentralization roadmap that's kind of going back 3-4 years by this point. And so when Lido started out, we were so early to staking. It wasn't even possible to control a validator on the consensus layer with a smart contract on the execution layer. Like that didn't even work. Like a validator could only be owned by an EOA. And so Lido actually started out as this multi-sig based solution in a way, where like there was one key that owned all the validators and they were, split out using MPC. And the first thing that we did was replace this EOA with a smart contract. Now dual governance is effectively replacing that or upgrading that smart contract with a veto right. So that's already kind of the second major step in that area. Earlier this year, we, Ethereum added execution layer triggered withdrawals. So now Lido smart contract system can also force withdraw from the consensus layer, even if node operators, for some reason, they go rogue and they refuse to give the money back. So that's another big element. And then last year, another big area was basically how do you become a node operator? How is the stake distributed across those different modules that we have? And so we added community staking module, CSM, and distributed validator technology, DVT, to make staking permissionless in Lido. Not just, so it's not only permissionless for users, but it's increasingly also permissionless for node operators. And so we have this decentralization roadmap that's going back at this point many years, and I think many people are not really aware of that. They think, Lido is maybe reacting in response to, because Lido got so big and there's public pressure put on us. And like, the reality is you can literally go back to like read our blog, and it's there like 3-4 years ago, exactly laying out, here's what we will do over the next 5 years to make this protocol completely neutral, thin, permissionless, decentralized, secure, middleware that people can just use to stake, that other people can run, nodes for, and that gives you liquidity on that stake. And that is otherwise completely safe and unopinionated. And by now we're like 80-90% there. And, it's been it's been such a great experience, just like working towards this roadmap over time. And I see dual governance as a major building block in this journey.
And I know you did a number of things to make sure that this new system would be resistant to various types of attacks, including economic ones. Can you describe how you did that?
Yeah, it was based on agentic simulations mostly. We categorized the current stakeholders into agents, the current big users of stETH as well. Like one of the biggest stETH users, like holders in the overall is, for example, Aave. And Aave is upgradable contract, so governance attack on Aave could result into a big amount of rock stETH. So like we had analyzed things like that. And we put the parameters to that, like how likely they are to react to the news, how likely they are to be harmful. Like what happens if a big ETH holder or an agent of ETH holders like Binance or Coinbase or some custody is exploited or something like that. And what happens then? So we put some probabilities to it, some numbers, and that's how we reasoned about the stETH side of attack. On the LDO side of analysis, we didn't do much work here because like the whole premise of making a dual governance is considering that there can be governance compromise. So we kind of assume that like, okay, if there is a compromise of LDO holders, can stETH holders still rage quit? So that was a question that we analyzed with agent-like simulation, basically.
I wondered, for that example that Vasiliy gave, so could there be like a single stETH whale that like repeatedly triggers max delays, or how would you deal with that? And then even for people who hold LDO, so for the opposite side, for people who hold LDO, there's kind of an incentive there, or they have like this interest because they can influence this DAO. But now is there like less of an incentive to hold LDO because these stETH holders could veto the LDO decisions?
Yeah, I can maybe take the last one first, because this is a question that I really like. It's been asked many times over the course of us working on dual governance. Like, will this make LDO in some way less valuable? And I think for me, it's a clear no. I think it's quite the opposite, because the value of LDO doesn't come from the ability to make negative proposals and steal money. So for every LDO holder who's actually a good kind of long-term oriented investor in the protocol, in the DAO, right, and the participant, for them, a governance attack or something like a hostile takeover is just as much a risk for their investment as it would be for a staker. And so now I know that Lido overall as a business is becoming much more durable, right? It's becoming much more secure from any kind of attack. So that's the first side. The second side is now the trust required from a staker to use Lido is also much lower. And so to the degree that this converts to more usage, more people using Lido because they really value the security and the decentralization, maybe folks who were previously only using direct staking, who said, I would like to have liquidity, but not if it comes at the cost of, giving up my security, right? So I want the highest security. And, to the degree that now more people stake with Lido, this is again very good for LDO holders. And so I think it only takes away, there's positive rights and there's negative rights in that sense, and or positive commitments and negative commitments. And so to the degree that the ability to make negative actions in any kind of multiplayer game can be removed, it actually increases the value and the space in which cooperation can happen. That's then kind of really zero sum and wealth creating. And I think that's a great example of that.
Vasiliy, do you want to add anything?
I'm going to rephrase that, I think. So it's going to be the same things in different terms. how I think about it. What dual governance does in terms of power to the LDO holders, it removes the power to make changes that are really harmful for stakers, like stealing stake or putting like 100% fees, things like that. I don't think it's a meaningfully valuable thing to lose. And I think it actually improves quite a bit on the product and makes it more attractive. It's one of the main questions you hear when you talk with some stakers that choosing between different staking providers. Like, what happens if governance compromises? Like, what's your risk management practices? Like, what happens if like Lido goes rogue? And this is a question that is asked by the likes of fund managers, for example, of big institutional actors, stuff like that. They are really conscious about that. The governance risk is one of the things that they're used to evaluate in corporations in when evaluating country exposure risk, like asset exposure risk. And DeFi and crypto are no exceptions to how people think about risks, and governance risk requires real mitigations. And if they are based on smart contracts, it's more sturdy than anything that is based on the traditional law, basically. So I think that's a good change that will bring more stake in exchange for losing the power that shouldn't have been there from the start. But it's not right for the staking protocol governance to have the right to steal the stake. Like, it shouldn't be like that. And I think it's overall positive change. In terms of, if we go back to the initial questions, what if some big stake holders decides to just stall any changes and stuff, right? I think that if you're talking about a big user of the stETH protocol, like a genuine user that is like there for a reason for a long time and intends to stake for a long time, they already have a pretty big bargaining power versus the DAO. So like if 10% of stake say that, okay, folks, please don't trade the fee to 15%. It's right to listen to the staker, because like that's what good what good product is. Like, you're solving the problem of a user, and you do it in the way that is good for user. This change just makes it very clear about how they can go about, like, what are the options of the big stakers to go about the actual power they already have, because they have the power to stake with Lido or not to stake with Lido. That's if they can do whatever they want with this, right? So that just gives them the rails. And if we're talking about some kind of grifter attack, like rogue ETH that, I don't know, have been stoned by like hackers, and they don't like try to find a way to and they can't sell it on exchanges because it's like compromised, and they have to find a way to use it in a way for profit, they can't really stall the protocol for long. What they can do is to trigger the rage quit, be unstaked for the protocol, and that's it. That's what they can do. And they have an opportunity cost for that. So like, this is while they eat in this loop of like making a dual governance vote for the protocol, they can't do anything else with it.
I did also want to ask, so turnout was just over 5%. You know, the quorum was 5%, so it just barely met the quorum. So how do you think you can fix voter apathy generally, both for LDO token holders and staked ETH holders?
Yeah, and so I wouldn't say, this is necessarily such a bad sign, because yes, the quorum is 5%, but then like once 5% is reached, what's your incentive? What's the incentive for someone to vote whose vote will not in any way like influence the result anymore, right? So I think we have seen in other DAOs, in cases where a vote is actually contentious, all of a sudden you have like much higher turnout of people. So there is a bigger universe of people who will vote when it matters, But once 5% is reached, basically, like, why should I vote? It costs me probably a couple bucks and like, a couple minutes on my hardware wallet, right? So I think that's not really a surprise. So that said, I think, in general, there's a couple of ways that you can attack this problem of just like getting more turnout in general. One is you can attract LDO holders who are more active in general, who are more long-term aligned and strategically thinking and want to be involved, and you can give them the tools to do that. So you kind of proactively, like, you choose your own LDO holders and empower those who want to participate. And I think we're really trying to do that. What else can you do? So you can try to remove the need for as much voting to happen. I think that's kind of attacking the problem from the other side. So I'm generally a big proponent of the idea of optimistic governance. So if you look right now in Lido, even when a node operator is like rotated out of the node operator set, that is something that goes into an on-chain vote. Is that really like is that such a consequential decision for, LDO holders or stakers that this needs to be voted on? So in my mind, the answer would be no, right? So you overall kind of really compress the things that need to be voted on. And then, it's, when there's fewer votes and you bundle them more together, and so the overall effort is lower, I think that's the other big thing that you can do. And you want to do that in a way that everything that is actually important and that touches important parts of the protocol still goes into an on-chain vote. But then other things maybe go on, something that we call like fast track or optimistic governance, where different teams can just decide it, different domain level experts can just decide it. And then maybe if nobody objects within a week or so, then it just becomes activated, it goes on chain, right? So this is, very much same idea. We've been using something like this in Lido for a long time for some decisions, but not others. It's also what, for example, optimistic rollups are based on, just the idea of, it just happens. And then there's a waiting period. And if nobody objects, then it becomes finalized. And I think more governance should over time migrate to this kind of theme. And especially when you have dual governance, I think it's going to open up doors to move to this more optimistic governance in the future.
That like low quorums are a fact of life for many decentralized governance. Like this is how it is. Like many people don't want to vote. They want to own the token, but only interfere in matters that they first, like, on one hand, they think very important, then they think are very contentious, and third, they understand. So a lot of votes that get to the status of a voted in proposal, they are not controversial, and people don't think they need to express their opinion. Basically, they think that it's going, like, someone is going to vote for it. So, like, that's how it will be. And I think that the behemoth of the size of dual governance and, like, in general protocol upgrades still need to go in through that process, like the full process of token holder voting. But in general, yes, a lot of things, especially with safeguards such as dual governance and other ways of, like, safeguarding against bad actors, should go through the optimistic governance processes, like easy track voting in Lido and stuff.
Okay. Well, I did notice also, so wrapped versions of stETH in systems like EigenLayer and Pendle are not eligible to vote. Why is that?
Wrapped version of stETH is not upgradable contract, and the ability to vote with stETH in this contract cannot be implemented by a token upgrade. Implementing a custom voting system for every place that holds stake tether is out of questions, but maybe wrapped stETH needs to be implemented as an upgrade. Right now, it's not that important. The reason is unlocking stETH from wrapped stETH can be done within the same transaction. It's not a long process. It's something that can easily be done if you want to rage quit, basically. It's not imperative to have this ability to vote with wrapped stETH because, like, it's a matter of convenience, not ability. Making something about making convenience better is is valuable, but not so valuable to, for example, delay the launch of dual governance by like 3 months or something. I didn't dig into how stETH in Eigen layer and other places work, but I think it's the same reasons. Like the contracts where stake tether resides are not upgradable, and thereby they can't be used to initiate a vote, like to participate in dual governance. I think that's it. But I didn't dig in. For overall stETH, I know the answer.
Hasu, do you want to add anything?
No, I think that captures it.
All right. So institutions, can be concerned about how governance will affect them. And I wondered how you felt dual governance moved the needle for treasuries that held stETH as collateral.
That's more safety for them, like institutions and people and protocols that hold stETH as collateral. They will be more safe knowing that there is always a way to rage quit. There is a governance attack.
Yeah, I mean, I think we keep coming back to this idea that I think the largest investors have the highest demands in terms of security, sometimes from their own accord, sometimes imposed by regulation, which gets more strict and onerous, the higher you go up the food chain in terms of institutional capital. And I think this bridges the gap between security and liquidity, which in particular, I think as we are starting to speak about kind of ETP, ETF-like products, what we found is that I think this would be, for between these products, as Ethereum staking becomes unlocked, it will, to a large degree, will be a competition between who can stake the most ETH, right? Because you need to, on the one hand, optimize for the APR that you give to your users. And on the other hand, you need to optimize for liquidity when they want to withdraw, because you have, again, regulatorily imposed withdrawal times that you need to service, right? And so you're trying to maximize both of those things, and then you're optimizing like security at the same time. And so I think dual governance really helps by adding this layer of security that previously didn't exist, it really amplifies the benefit of the liquidity that Lido already has, and where it's the market leader, and kind of brings that more into play. And I think it will just allow these issuers to stake more of their customers' ETH and give them an overall higher APR without increasing the liquidity risk or without increasing any security risks. And so on net, I think it would be a big improvement for users.
All right. So last question here. Obviously there's a lot of systems that probably might find this interesting. So I wondered, whether you felt that this model might spill over to other protocols. I don't know if you've been hearing from other people, from other systems. And, just as like a point of comparison, MakerDAO's like emergency shutdown module is obviously a sort of different way of handling it. So I wondered if you could just talk a little bit about like how you see this could affect the wider DeFi world, or, why it is that you chose something that's a more gradual response than Maker's emergency or Sky's emergency shutdown.
So, I think that Maker back then, when it was still called Maker, I think was struggling with a similar problem, right? You needed, this was a smart contract that you needed to be upgradable as well, because interest rates needed to be changed, new collateral needed to be added as kind of more people were buying into DAI and kind of creating these deposits that then needed to be like invested in something, right? In order to generate interest on it. And I think they were very ahead of their time in designing this kind of poison pill mechanism. But the poison pill mechanism, kind of the threshold, was raised over the years, I think multiple times, because when this becomes triggered, the protocol actually shuts down. There's like no way to stop it at this point. And So I think as a very long-term kind of MKR holder and participant of that community, I always saw it as a really double-edged sword. So I think it's great for users. It made me feel better about holding DAI and now holding kind of USDS. But as an MKR holder, it also felt to me like, wow, like somebody can just buy or borrow 5% of MKR and they can just shut down the protocol. And so, it can be restarted, but who says that the same people are going to deposit again, right? So if you're a competitor, you can really destroy like all of the network effect of that system. And so I think this one was really calibrated in a way that like it optimized in terms of user security because of kind of its simplicity and rigidity, it was not really kind of the optimal mechanism. And I think dual governance brings us way closer to that because it provides this, much more kind of, there's no shutdown per se, right? Like, so you just, you can withdraw if you want to, but you don't have to. And if enough people have withdrawn, actually the protocol goes like back out of the shutdown, right? And so I think it's just this much more elegant idea of a dynamic time lock that extends the time lock as long as it needs to, but no longer. And so I think that's what makes this more elegant. And so will this be present in every protocol? I think, some protocols have an easier time designing exit rights for users. Why? Because they can just implement shorter time locks kind of period. But longer time locks have a certain beauty to it in the sense that you don't need to be watching your crypto all the time. And I think as this becomes a major industry, a major asset class, you want to give this industry won't consist of people who are like terminally online, and like are watching their portfolio every day or every week. And so I think just by making these security systems more working also for people who maybe check their portfolio every 6 months, every year, I think we gain a lot of kind of peace of mind also for those investors and kind of players who are not themselves kind of at the cutting edge. And so I think something like that, just this idea of the dynamic time lock and kind of giving users a voice in the protocol, I hope that something like that will catch on everywhere.
There is a balance between the safety and usability. Like complete ability to shut down the protocol would be like if some threshold is reached, would be safer for people who can't reach their keys for 45 days, for example, right? So if I am on like half a year sabbatical, I don't have an opportunity to react to governance attack, essentially. And I think that's not as good as having someone to save me, basically, and to react in time and direct the protocol on one hand. On the other hand, it opens up the protocol to the external attack. Like there will be more ETH outside and in Lido, and there will always be someone holding enough ETH to break the protocol. And one big thing about like how do you think about that? Like you can't assume that the adversary is rational. Because the adversary can essentially do some kind of identity theft. So steal the private keys or find out a bug in smart contracts or like of smart wallet or compromise custodial solution or something like that. So like you don't know, like you can think about an owner of a large amount of it that they will not probably do this. Like you can be reasonably safe that they will not do anything like stupid or reckless for no gain, essentially. But you can't think in these terms about in general, because I think like hacks happen and they happen in huge amounts. Like Ronin hack that was mostly ETH, I think was $800 million, like right in size. And that just like the biggest hack we had. The biggest hack ever will be bigger than that, so we don't know. the same reason we can't assume that LD holders will be reasonable people, that they can be compromised, right? We can't assume that ETH holders will be reasonable people and will not try to break the protocol. So is there asset like staked ETH that is always under the risk of external attack a better asset to hold than one that is you can always flee from, but you can't guarantee that it's shutdowns like for everyone when that happens. It's a judgment call. You can't say one is definitely better than the other because it's for different people, it's different things. But my impression is with dual governance, Lido and staked ETH is already ahead of the curve on security there. And it's better than most staking, forms of staking in Ethereum and otherwise, and in terms of security and risk management. And perfect would be the enemy of good here in terms of security, and it does add additional risk on the asset that is probably not worth it. So you can say it's someone can say that they would make the decision differently if they were to decide. Lido token holders essentially voted for this option, so it's reasonable.
All right. Well, this has been such a great discussion. Thank you both for coming on Unchained, and also congrats on something that you've been working on for so long passing.
Thank you.
Thanks, Laura.
Thanks so much for joining us today. To learn more about Hasu, Vasiliy, and Lido's dual governance, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Juan Iranovich, Pamela Jimdar, and Margaret Correa. Thanks for listening.